acquisition that must be financed in the equity market on a given day, or Armageddon follows. And so I think the deals that we've seen, even very aggressive or ambitious deals, generally speaking, are financed in a way that the hope is the equity market will take it out. But if the equity market doesn't take it out, or shuts down, or if it comes to an unattractive price, and you're at war with your potential buyers of stock when they know you have to issue, I think most companies simply would not put themselves in that position. And so that may mean bringing in partners, which are readily available. It may mean drawing down lines that will leave you more levered than you want to be in the short term, but there's some duration to it. You can live through it. But I think taking risk on an acquisition, as almost no matter what it is, you're betting the company on it against the equity markets or changes. I don't see anyone prepared to do it. And certainly the boards of two larger public companies, I don't think anyone does something like that.
The old model, right? And then not that old, throughout the 2000s were bridge loans, right? You never, to your point, I want to be stuck where you have a deal, you announce it, you have a contract, and you cannot finance it, right? So folks would, put bridge loans together with their friendly bankers, and then have a plan to take that bridge loan out, either through equity or more permanently financed debt. And if that didn't work out, most of them worked out, but when it didn't work out, you have this great thing called the hung bridge, which you never really want to have. I mean, isn't it an inevitability? I'm sort of playing devil's advocate that we're going to get back there. There's a deal that really makes sense, right? That's what this is all about. A fit that really makes sense that you think is going to take your company to the next level, but you have to go through that to get it, because you can't get it without uncertainty. Don't you think people are going to get back there again?
The reason I'm smiling is because I've never seen that deal. I've never seen that deal. That makes so much sense.
On the M&A side,
what's that?
On the M&A side,
yeah. And so I completely, agree with Matt on the company type of deal like that, no question. And it's not an issue on a smaller deal. It's that middle of the road. It's that great portfolio, depending on the size of your company. Maybe it's a couple of $1 billion or something like that in size where you have this issue. I just smile because I would love to be in that position, and I've never been able to find a portfolio that I really thought would be good and additive to what we've got, but I'd love to be in that position. You think about, David Hithercutt and I don't know if David's still in the room, he was on the last panel with Tim Naughton, and what those guys just went through with Avalon and Equity Residential. That's some tough stuff. There's some, that was a heck of a transaction. I can't imagine the nights of soul searching that happened in there.
It's a good point, because it just got, what I'm describing sort of just got done, right? And it worked. I think that's really the...
And I think it would have to be an extremely large portfolio, and because otherwise the only situation where this is going to be relevant is if we're talking about distressed assets. Right, because anything high quality right now, any core assets right now, if you think about our earlier conversation, there's so much competition for those assets out there in the market right now. Even medium-sized portfolios, but any large asset transaction or medium portfolio transaction of any quality has multiple cash bidders out there. So the idea of being in a position to acquire a portfolio that's high quality right now, to go out and to have to raise equity as a part of acquiring, you've essentially knocked yourself out of the bidding process there.